Your health could go south, and it's a moving target. Inflation, we can predict it, but it's not 100%. But tax, we get a handbook, and that handbook tells us where and when we can make deductions and how to lower your taxable income. Today, we're gonna talk about the rule of 20% and how we're gonna stretch your money at retirement. Let's go behind the vault. Okay, so today we're going to talk about tax. And when it comes to tax, it is one of the three things that will absolutely or can absolutely decimate your financial plan at retirement. So the three things at retirement that can wreck your financial plan are health, inflation, and tax. Health is a moving target. You don't know if or when it's going to happen, right? And you sort of have to roll with it when it comes. Inflation is fairly predictable, 2.5%, 3%. Your money needs to make every year to keep up with cost of living. The one thing that's not variable is tax. And the great thing about tax is that the CRA gives us a handbook, and we can work with that handbook to minimize the amount of tax you pay at retirement and maximize your money. Keep it for as long as you can and stretch it for as long as you can. Because I will tell you this, if you run out of money at retirement, you're definitely going to find out how much your kids actually love you. So how about this? How about we just don't run out? We be as efficient as possible. And we're going to do that with the rule of 20%. Let's get started. Okay, so let's do this with an example. Let's say we have a retired school teacher and she and her spouse are retiring at the age of 60. They're going to take CPP early, and she's got a teacher's pension. Her pension's about $60,000 a year, and he's got RSP savings that he's built up throughout his career. They're going to take CPP early, so they're going to get a bit of a reduction, and their retirement income needs are about $63,000 a year, and that's for everything. They can fund their entire lifestyle with that. All right, so let's see how this works. If we take a look at their financial situation and the income that's coming in at retirement, they each have about $8,000 of CPP coming in, which is Canada pension. Neither of them have old age security coming in yet. They're not 65, but when 65 rolls around, that's going to kick in. So that'll be an extra, $5,000, $6,000, $7,000 maybe with inflation by the time they get there. And then that teacher's pension of $60,000, they're actually going to income split that 50-50. Now, that doesn't mean that half of her pension is going to go into his account and he can do what he wants with that money. If you're somebody with a pension, when you income split that pension, it's just for tax purposes. So the $60,000 will still go into her account or their joint account, however they have it set up, but he's going to take on half that tax. And by doing so, it's going to lower their overall taxable income. They're going to be able to keep more of their money, which is great, and that money is going to stretch further. If she was single or separated, divorced, or widowed, she would take all that income on, all that $60,000 plus her CPP. It would bump her up a few tax brackets, and she's not going to be able to keep as much money as having that benefit of a spouse where they can income split. Now, they're each going to show $38,000 of income on pension income alone. And what's interesting is when you take the tax out that they're going to have to pay, they're going to be left with $67,000, which is $4,000 more than they need. So they've already said to us, hey, we only need $63,000 to fund our lifestyle. Their pensions alone are going to take out, are going to leave them with $67,000. So are they being tax efficient though? That's the question. And what we're going to do is we're going to take them a step further, and we're going to put them in a situation where we're going to stretch their money longer. So I'm going to tell them to take more money out of their RSPs, even though they don't need it. All right, let's take a look at what that would look like. So the question I know you're asking is, well, why on earth would they take more money out if they've already got more than they need? And the answer is tax efficiency. See, they're not going to have an opportunity to pay 20% tax again. So they're leaving room in the bucket. And we'll talk about that in a second. You'll understand what I mean. So let's take a look at where they're at, right? So they're going to show about $38,000 worth of income. I'm going to tell them that their ideal income for 2021 is to show $47,142 on their tax return, gross before taxes. So I'm going to advise them that they want to be taking out $9,142 each from their RSPs. So if the RSPs are under, let's say, his name, they can income split that. So they'll take out, what is it, $18,284, and they'll pay tax, based on 9142 each. And that's going to bring them up to 47,142. Now, why are they doing that? Again, and why is it the ideal taxable income? It's the ideal taxable income because of how the tax brackets work. So take a look. The first 13,808 is tax-free in Canada. It's called the personal exemption. So the first 13,808 that anybody makes and earns, whatever kind of income that is tax-free, zero. After that, you move into a 20% tax bracket until just over $45,000. Okay. Now, you'll notice, though, the ideal taxable income is actually $2,000 higher. And the reason it's $2,000 higher, and I've got here on the screen that they're actually going to pay zero tax on that, is because we have something called the pension tax credit. And the pension tax credit eliminates $2,000 of pension income. So on a defined benefit plan, so if you're a teacher, a firefighter, police officer, a nurse, for example, so if you're with HOOP or OMERS or teacher's pension, that $2,000 is a deduction that's tax-free. So the personal exemption is a little bit higher. So what's tax-free on that income isn't 13,808, it's actually 15,808. And what's really great is if you're income splitting, you each get that tax credit. So by showing just over $47,000 worth of income, $2,000 gets bumped off it, and that's tax-free. So now we're down to $45,000, which is the top of the 20% tax bracket. The next dollar over would get you into the 24% tax bracket. So what I'm advising these clients to do is I want them to bring their taxable income right to the top of the cup. So think of like a cup of water, right? And 38,000 isn't quite at the top, but 45,142 is. I want to bring them right to the top. And here's why. They're never going to get another chance to pay 20% on that money again. And that's the beauty of it, right? As I said earlier, if one person passes away, so if he passes away, she's going to take not only all the pension income on, plus her CPP, but eventually when age 72 rolls around, she's going to be forced to take money out of those RSPs. So that's more taxable income piled on. So what's going to happen is she'll never get a chance to pay 20% on that money. She'll be bumped into a 30, 40, 45% tax bracket. And on the other side of the coin, if she passes away, he's going to get about 65 or 70% of her pension, plus he'll have his RSPs, plus CPP, OAS. Eventually, the tax brackets are just going to keep going up, up, and up. So we want to be in a situation where while they're both still alive, right, and OAS hasn't kicked in yet, and they're not forced to take money out of their RSPs, we want to start chunking those RSPs out. Now, doesn't mean that they're gonna be in a situation where they have to spend that money. Nobody said anything about spending it frivolously. I'm telling them to take it out of the RSP because the RSP is a heavy burden tax vehicle. Okay, they're going to be forced to take money out of that RSP. They're going to be forced to take, it becomes income. So it's, those tax brackets are going to keep climbing. So what I want them to do is I want the client to understand, or I want you all to understand that at retirement, you want to run it up to the next tax line because you're never going to get a chance to pay that small amount of tax again. The next time you pay tax on that money, it could be higher, a lot higher. All right, so what if we don't need it? Let's talk about that a little bit. So let's take a look at their income now. They've got $47,142 each. So that's going to give us a family income of about $81,750 together. Now, there are some other deductions that we're not going to get into because I want to keep the concept a little simple today. Having a good accountant, or a good accounting tool is going to allow you to make that a little bit lower. But here's the thing. If you find other tax deductions and you can bring that taxable income down, you're just going to take more money out of those RSPs because you want to bring it right back up to that line of $47,174, right? That's the magic number. So now, if we take a look, they've got, $36,000 a year in living expenses, $12,000 for spending money, $15,000 for vacation. So with some planning, we figured out they're going to need about $3,000 a month in today's dollars. So $3,000 a month is for stuff that they have to pay for, right? Insurance, property taxes, utilities, maybe there's car payment, whatever, food, clothing, shelter, all the necessities, right? Stuff you sort of can't get away from even though you retire. And then they told me they're going to need about $1,000 a month for just frivolous spending. That's fine. So, whether you're going out for lunch or you're buying something or you're taking your grandkids out or whatever, right? And then they budgeted about $15,000 for a vacation. Now, funny enough, not everybody's going to spend that $15,000 for a vacation. They may not go on one big one. They may go on a few little ones throughout the year. Everyone's a little bit different, but, $15,000 is a pretty typical number. So, and that brings us to 63. Well, they're going to have $18,750 left over, right? Almost 20 grand. And here's the problem. If they spend it, what's the ramifications of it, right? Because some people are like, oh, just spend it then. Who cares? Let's go on a bigger vacation and let's buy a bigger boat and let's have a nicer car. The issue is that you've got to be careful because if you spend your money too fast and you run out, it'd be a problem. Now, in this couple of situation, they've got a pension, right? Like a really sweet pension with the teacher's pension. But you know what? If health goes south, and we've talked about it being one of the biggest retirement risks, if health goes south, that savings can really be used for health expenses. Whether you need to bring somebody into the house, or you need to retrofit, or you need something to get you up the stairs, or you need somebody to come clean your house now, or grocery shop for you, or put stuff away, right? So keep in mind too that while healthcare is free in Canada, the cost of care post whatever surgery or whatever you have is not free. So just keep that in mind. So what are we going to do with this money? So we are going to be very responsible. We're going to recycle it. And here's what that means. So by recycling that money is we're just shifting it from one vehicle to the other. See, I said earlier that the RSP is a heavy tax burden vehicle, and it is, because every dollar that comes out of that is taxed as income. So, if you let that thing pile up way too much, and then you're forced at age 72 to start making minimum withdrawals, well, those minimum withdrawals can start to get high and bump you into tax brackets that you don't need to be in, right? And then what happens? You get, if one spouse passes away, now you're in a situation where you've got the whole pension or a portion of, depending on who you are, as we talked about. And now you've got these RSPs that have gotten out of control. So we want the money to get out of control as far as growth. We don't want it to get out of control as far as tax. That's the key. So we're going to recycle it. We're going to look for vehicles that are going to help us grow that money. So one, a tax-free savings account or a non-registered investment account. With a tax-free savings account, as we know, all the growth is tax-free. So, they're going to take it out at 20%, which is the lowest tax bracket because we're going to be tax efficient by going up to the top of the cup. And then we're going to reroute that money into the tax-free savings account. And we're going to let that sucker grow tax-free forever. And the beautiful thing is the government never comes and says, hey, you need to start taking money out of your TFSAs now and spending it. Because they've already gotten their tax on that money, right? That account is funded with after-tax money. So they don't care how long money sits in there, right? What about your non-registered account? If your TFSA is full and your partner's TFSA is full, the next stop is a non-registered account, and any growth in that account is going to attract capital gains, which means that only half the growth is taxable, not every dollar's income. See, with the RSP, the capital that you put in plus the growth is taxable as income. With the non-reg account, only half the growth is taxable as income. So it's a lot more tax efficient than the RSP is. And again, no restrictions as far as how much to take out and when to take it out. You could leave it in there till the day you die. Doesn't matter. The other idea is permanent insurance. There are some strategies around insurance where you can overfund an insurance policy, shelter the money, create like a supercharged TFSA, and then when you pass away, all that investment money converts to insurance and becomes tax-free for the next generation, or your church or charity of choice, whatever that is for you. So there are some neat ways with insurance that you can do that. And a lot of people think, oh, I don't need insurance. I've got my wealth. I've got this. Listen, at a young age, in a general statement, at a young age, insurance is used to protect your income. At an older age, insurance is used to protect your wealth. And there's a huge difference between the two, right? When you pass away, there will be taxes to the government. There will be taxes on your estate at a certain point, right? And what people do with insurance is they use insurance, split the bill. So, for example, if let's say I know that my tax bill is going to be 500 grand. I don't know, I'm just making a number up. What would I rather do? Pay 500 grand when I die out of my estate and my kids get less? Or would I buy an insurance policy that will cost me maybe 200 grand over 30 years, but then when I die, the insurance company is going to pay the 500 grand to the government? They're out 300. It only cost me 2, and my kids get an extra 3. I'm okay with that. Some people don't care, and that's fine. But insurance is a great tool to use, when transferring wealth from one generation to the other. The other option is, maybe you do spend it, or you upgrade your home and you build its value that way. Maybe you invest in a business. There are lots of people now that are they're retiring from the job that they had to do, and now they're doing the job that they want to do, right? So maybe you start a consulting business, or maybe you start a flower shop, or maybe you start a online business, or whatever. It doesn't matter. Maybe you take that money, you invest it back into yourself, and you can create income that way. Some people do what's called a living legacy. Is they start giving it away when they're alive, and they start to see their kids and their grandkids enjoy it. There's some pros and cons to the living legacy. You can pass money down with a warm hand instead of a cold one. Just be careful, right? So with these different vehicles, again, with the tax-free savings account and the non-reg, your money continues to grow, but now it's tax-free or tax-deferred. We use permanent insurance for probate, estate tax, inheritance to replenish the estate. And then if you go with the bottom suggestion where you spend it or upgrade your home or give it away to friends and family while you're alive so you can see them enjoy it, just be careful you're not overspending. All right. So when you adhere to the rule of 20%, you're turning essentially heavy tax savings into tax-free or tax-deferred savings. That's the strategy. The strategy is saying, okay, I've got all these different buckets of money at retirement. How am I going to push and pull with these buckets? See, when you were working, it was easy. You go to work, you get your paycheck, they take the taxes off, maybe you gripe about it, maybe you have to contribute to a pension like a teacher or a nurse, and you'd be like, oh, I'd love to have that money now. And it was all done for you. When you get to retirement, you sort of have to do it yourself now. And you're going to have these different buckets hopefully established, and it's never too late to start. As those savings grow, you get to keep more of it. And that's the best part. So you can go up a lifestyle rung, you can take a longer vacation, you can, stay a little longer, go somewhere a little nicer, maybe go first class, right? You can do more things for your kids and your grandkids if that's sort of, your style. So the idea of having your money stretch further, that should appeal to everybody, right? And then again, if you have a larger pension or rental income, people will say to me, Ange, I'm going to make way more money than that at retirement. What happens if I'm making 50 grand or 60 grand or 70 grand a year? My answer is going to be the same. You may not be able to adhere to the rule of 20%, but maybe you're the rule of 30%, or the rule of 33.2%, or the rule of 43.1%. Whatever the number is, the concept behind the strategy is that you want to run up the tax to the next line, right to the top, because you're never going to be able to pay that amount of tax again, ever. Chances are it's going to be higher, either for you or for somebody else, right? And your estate. So at the end of the day, you worked your butt off for it, didn't you? you scraped and clawed, you went to work when you probably would have rather hung out with your kids or your spouse or your friends, right? How many times did you say, oh no, I gotta work tomorrow, I gotta go, right? You were being responsible. Well, let's take it a step further, right? If you just throw that money away in tax, what's the point? I don't know.
Okay, so that's it. That's the rule of 20%. Again, it's very, very important to understand that when you get to retirement, you know, the responsibility is still there, and you can still, without even thinking about it, pay way more tax than you need to. Remember, there are 3 things that are going to kill your retirement plan: health, inflation, and tax. Health is a moving target. Inflation is somewhat predictable, but tax is definitely the one where we get a rule book every single year that allows us to be as efficient as possible when it comes to our income for the year. Okay, so if you want to learn more about how to stretch your money at retirement, how to reduce your tax, and make sure that you don't outlive it, head on over to behindthevault.net and maybe we can help you out. In the meantime, like and comment down below, smash that subscribe button, and here's our next video.